You have been given this income statement and you have been asked to analyze the variances on this income statement. So you have actual results for the current year, you have budget, and you have prior year results. And then on the right side, you have variances versus budget and variances versus prior year. What are the first few questions that come to your mind? Let's take a look at this. If you look at your sales versus budget, you see that your sales came in short by 16 million and your EBITDA, earnings before interest, tax and depreciation, was also short by 3.6 million. But when you look at your EBITDA percentage, which is really your EBITDA divided by your net sales, it is actually higher versus budget by 0.8%. You can see it here, 27.2% for current actual year and 26.4% for budget. So what's going on there? Similarly, if you look at your last year results, you see that in current year actual sales are below last year by 2 million and your EBITDA is actually higher than last year by 2.3 million, which results in your EBITDA percentage to be higher than last year by 4.4%. How do you explain that? Similarly, if you look at your gross profit versus budget, you see that your gross profit was actually below budget, but your gross profit margin is above budget by 2.2%. And if you look at your transportation and insurance costs, they are favorable versus budget, they are favorable versus last year, but are they favorable enough? Because you know that your sales are below budget in last year. So in line with your sales, your transportation costs should also drop because you're selling less means you're shipping less, right? But is this enough? Is the drop you see here in line with the drop in your sales? In this video, I'm going to show you how to create a calculation in Excel so you can answer all of these questions. I will show you exactly how to calculate the variances in amounts. So for example, the 0.8% favorable variance in EBITDA percentage versus budget, what does it mean in terms of dollar value? And if you want to look at the split on all of your income statement items, where is all of this variance coming from? Similarly, I will also show you how to explain all the variance related to prior years. This has the potential of changing the way you look at and analyze income statements forever. So keep watching till the end because you can create these templates immediately after watching this video and add it to your existing income statement analysis. If you haven't subscribed to my channel yet, what's stopping you? Go ahead and subscribe and make sure you watch other videos on my channel. Okay, let's start. So the first step in calculating the variances is you will create columns on the right side and you will calculate the percentage of net sales. So each amount in your income statement, you would calculate what does it represent in terms of percentage of net sales, right? So the first column is related to actual, the next one will be budget, and the final one will be prior year. Let's start with the actual column. So I'm going to calculate freight cost, transportation and insurance cost divided by net sales, and I'm going to partially freeze the net sales cell reference by pressing F4 twice so that only the row is frozen but the columns are not frozen, as we will need to drag them further for budget and prior year calculation. So I press enter and then I copy this formula for all the line items of the income statement, and it shows us their respective actual amounts as a percentage of net sales. Now as I copy this information for budget and prior year, and you can check this, yes, similarly prior year. So we have now calculated the percentage of net sale for each of these individual amounts. The next step you're going to do is you're going to calculate what is the difference between actual and budget and what is the difference between actual and prior year. So first we do versus budget, and the way I like to do these calculations is that I always want to see favorable variances as positive numbers and unfavorable variances as negative numbers. So transportation and insurance is an expense, it's a cost. The lower it is, the better it is, or the more favorable it is. So in this case, since the transportation and insurance as a percentage of net sales is 8%, and budget was 10%, it means that it's a favorable variance. And to show that as a favorable variance, the formula would be budget minus actual. So you see it's a number that is +1. It's rounded, so you don't see 2%. It's actually a rounded number, and you can look at this. So it's actually 1.21. And if I show the decimal places here also, you will see that the formula or the math is still working. Okay, anyway, just to keep things simple, let's keep it like this. Okay, and similarly, we will do the calculation for prior year, and it's the same. It will be prior year number minus your actual. So while budget was in the case of versus budget, you did budget minus actual. In the case of prior year, you would do prior year minus actual. And then similarly, you can copy the calculation all the way down for all line items. Okay, now is the critical step, because you are going to convert these variances into dollar amounts, which will show you exactly how each of the line item on the income statement is impacting your gross profit percentage and your EBITDA or net profit percentage, right? And by the way, in this income statement, you only have gross profit percentage and EBITDA percentage, but you may be using other names such as gross margin or net profit or net margin. This calculation will work exactly the same as long as you understand the concept. Once you build this file this way, it will always show you the same results, and you will be, and the good thing is you can always check it, and I will show you how to check this calculation as well. Okay, so now it's time to calculate the dollar value in terms of budget, and you will calculate this by simply taking your versus budget percentage and multiplying it with net sales of current year. This is important. You will, this number, the $60,731,000 US, this number is important because it represents actual net sales, and the calculation you will do from here on will be on this actual number, right? So you press enter and you get 734,000, and this 734,000 shows that the impact of transportation and insurance on your gross profit percentage or your EBITDA percentage is favorable as a result of these $734,000. Or in other words, you can say that if you had spent at the same level as budget, which was 10% of your net sales, you would have spent $734,000 higher than the 5 million that you see right now. But since you didn't, and that's what we are trying to explain here, this calculation shows you exactly this is the amount, favorable amount, that resulted in your favorable gross profit and EBITDA margin. But this is only one of the items. We have to calculate it for other line items as well. So you can simply drag the formula down. It will do the calculation by itself. Since we have already frozen this net sales cells, that shouldn't change. Let's copy it and drag it down all the way to depreciation and amortization. Let's add totals here. So this one will be sum of the two. This will be sum of these three items. Okay, and finally your total EBITDA would be your gross profit plus negative logistics and SG&A expenses minus depreciation and amortization, because you know earnings before interest, tax, depreciation and amortization, in this case you will exclude the amounts for depreciation and amortization, right? Even if you look at your EBITDA calculation here, you see that you have EBIT of 9.8 million, but you are adding back the 6.7 million. And the reason is that this depreciation and amortization is already included in your SG&A expense here, right? But we need to take it out because when companies are looking at their EBITDA, which is earnings before interest, tax, depreciation, and amortization, they exclude expenses such as interest, tax, depreciation, and amortization. Now in this income statement so far, we don't see interest and taxes, so we do not need to exclude them, but we do see depreciation and amortization in this number. So we have to exclude it to get to the EBITDA number. And you can see the EBIT is actually lower than the EBITDA, and the difference is really the depreciation and amortization. Okay, so if you look at your total variance now, you see that it's $467,000, the sum of all of these elements. And you can test this too in various ways. The first test you can do is if you add this 467,000 to your actually subtract, because it's a favorable variance, if you subtract this 467,000 from your current EBITDA, you will see that your EBITDA margin would go back to budget number. So let's quickly, just for the sake of testing, let's do that. So 467, as soon as I deduct, you see your EBITDA margin is exactly the same as budget, right? So this shows exactly $467,000 is the impact on your current year EBITDA, which is the favorable variance, which shows higher EBITDA margin. But this is not how we should do it, right? This was just for a test, a quick test. Let's undo by pressing Control and Z. So bring it back to its original condition. But this is one way to test it, but we also want to test it in another way and also get some more information. So I want to see what is the impact on EBITDA or gross profit margin of each of these individual items, right? So this for transportation and insurance, what is the impact of this $734,000 on the gross profit margin and on the EBITDA margin versus budget, right? So for this, again, all I need to do is just take the number 734,000 and divide it by the net sales number. This net sales number, as I mentioned, was really important. And why it's important is because all of our margin calculations, the percentage calculations, are based on this net sales numbers, right? So if I look at gross profit percentage, you see the calculation is your gross profit divided by net sales. Similarly, if I look at my EBITDA percentage, the calculation is EBITDA divided by net sales. Okay, that's why this number is very important. And straight away we have the result. We know that 1.2% out of the variance of 2.2% is from transportation and insurance, right? So in the variance section, you see that your gross profit margin is favorable versus budget by 2.2%, and 1.2% we already know is from transportation and insurance. And similarly, if I copy this formula down, it will show me another 1%, and you can see that if I sum the two, this is exactly the 2.2% that we are showing here. Okay, but we won't stop here. We will drag it down. So copy the formula, do it for other line items on the income statement as well. And let's do the sum again. Okay, and for the total, the calculation will be similar. It will be your variances from different line items, but you will exclude your depreciation and amortization. And look at this, 0.8% is the variance you see on your EBITDA margin. Okay, isn't this amazing now that you know exactly what is causing the variance on your line items, and you can drill down further on each individual item, right? So if I summarize this variance so far what we have calculated is that overall our EBITDA margin or our EBITDA percentage is higher than budget by 0.8%, which equates to $467,000, which is split as follows. From transportation and cost of goods sold, we have a favorable variance of 2.2%, and from selling, general and admin expenses, we have an unfavorable variance of minus 3.7%. But if we exclude the depreciation and amortization impact from it, which is your 3.7% minus the 2.2% up there, the net impact is minus 1.5. So we can say that SG&A and logistics expenses and R&D expenses combined, if we exclude depreciation, had an impact of minus 1.5, right? So if you add minus 1.5 and 2.2, then you see that the net total is 0.8%. It's a small number, you can see, but anyway, if you add these two up, you will know that the impact is 0.8%. Isn't this amazing? So now you can drill down, right? So if you want to look at the 734, now you can pull up all the details and see what's causing this lower spend by $734,000, right? Yes, we had a drop in sales, but even despite the drop in sales, we are seeing variance of 734,000. Now the total drop in versus budget is 2.2 million, right? But not all of that is purely because of better spending on freight costs, right? A big chunk of that is because of the drop in sales volume from 79 million that was budgeted to 63 million. But now we know exactly what is the impact of volume, which is in this case the difference between 2.2 and 734, right? So if I just want to show it here quickly. So we are saying about 1.5 million of the total 2.2 million gap versus budget is as a result of volume, and the other 734 is probably due to other factors, such as maybe the prices have dropped, maybe the mix has changed, where we ship the products and which transportation carriers we use. There are multiple factors, but anyway, you have the number to work with. You know what number to work with. Similarly, for cost of goods sold, you know that except for volume, I mean, you can see that the overall drop is 9.6 million, but this number does not help you much because your actual sales has changed. So you need to know exactly what is really driven by cost savings. So this $620,000, again, this could be as a result of mix, or this could be a result of the cost saving measures that have been undertaken, right? So we have lower costs. It could also be a result of lower raw material or a purchase cost. Whatever product we purchase, the price has gone down, right? So there could be multiple factors. By the way, I do have a course related to the impact of variance in sales, so sales price, volume, and mix. And if you want to take a look at that course, click on the link in the description below, and it will take you to the course which explains this in detail. If you want to analyze this further, what is the impact on gross profit or gross profit margin from those variances. Okay, so anyway, now you have a clear understanding of what variances you need to drill down further, which are not related to just the volume drop, just the sales volume drop. Okay, let's quickly complete the calculation for prior year as well, which will be exactly the same. So for the prior year dollar variances, what we will do is we will use the change in percentage for prior year this time, but again we will multiply it by our current year actual net sales. Okay, so here you can see the impact in dollars, and if I copy it all the way down, oops, forgot this one. Okay, and similarly the formula for change in percentage would be similar as well, again divided by the net sales for current year, and copy it down. And then simply add the totals. So take a look now. If you look at your gross profit percentage, you see that the increase is 3.8% versus last year. And you can see it here, what is causing this. So again, transportation is 1.5% and cost of goods sold is 2.2%. And in terms of dollars, you also have the amounts here. Similarly, you have the same information for logistics, SG&A, and R&D expenses, the impact from depreciation. And finally, your total EBITDA change, 4.4%. It increased from 22.8 to 27.2, which is also reflected here. So again, individually by line items, you know what is the impact on your gross profit percentage or your EBITDA percentage. So again, great analysis to start with, and then you can drill down on this information. And this information, these variances could also help you develop a waterfall chart or a bridge for your income statement variances. And if you need to learn how to create a waterfall chart, I have a video on that in detail. There are different versions of Excel now. So I think anything before, all the Excel versions before Excel 2016 did not offer the waterfall chart. So my video will show you how to create a waterfall chart manually. So going back to our questions, why is EBITDA margin favorable when sales and EBITDA are unfavorable? We know exactly why. We know that a big part of that is transportation and cost of goods sold, although we had unfavorable variances in logistics, SG&A, and R&D expenses. We still came up with $467,000 favorable, and that impacted our EBITDA margin by 0.8% in favorable variances. Similarly, for last year, why is our EBITDA and our EBITDA margin favorable when sales have dropped? Well, we know again it's transportation and cost of goods sold, which were favorable by 2.3 million. And then our SG&A and logistics and R&D expenses combined were still slightly unfavorable, but really the big impact of the favorable variance on transportation and insurance, 3.8%, really overshadowed the unfavorable impact of 0.2% on SG&A, and that also included about 0.9% of depreciation and amortization. So in that case, really all of those items were favorable, resulting in a 2.7 million favorable variance, which equated to 4.4%. The same can be applied for the gross profit versus budget and the gross profit percent. Go back to your calculation. You can see that your transportation and your cost of goods sold were favorable, which impacted your gross profit margin by a favorable 2.2%. And finally, the transportation and insurance costs, were they favorable enough? What do you think is the answer to this question? The answer is yes. If you look at your percentage variances, both last year and current year, you see that it is favorable by 1.2% for budget and 1.5% for prior year. And this shows that even if you take out the impact of volume, which we have already excluded in this calculation, even if you take out the impact of that, your transportation and insurance cost is still favorable. So yes, the drop in transportation and insurance costs for budget and prior year were actually favorable. So if you want to understand the detailed analysis, the drill down, make sure you subscribe so that you will see my other videos where I analyze individually some of these line items. Now I want some feedback. Did you know this information? Did you find this information helpful at all? Can you leave some comment and let me know? Does this make your life easy when trying to analyze and presenting income statement analysis during your presentations and meetings? Does this help you at all? Make sure you leave a comment and let me know. Okay, thank you.